Hello everybody, I am Miss Meenakshi Dubey from Kotak Mutual Fund. Today I will take you through part C of our module Handling Investor Emotions. So before stepping into our current video, let's have a quick recap on the points covered in part B of this module. So the points that we covered were how market declines are part of investing and these declines are inevitable. The correction in the bear market, etc., had not lasted forever, so it is important for us to stay invested to get the compounding benefits. At the times of market turmoil, it is important that the investor should not panic. It is also important for the investor to know your risk tolerance. Diversification is something that can be adopted in order to have a long-term returns. Investor needs to control emotions as it hampers the returns in a long term. These were the points that we discussed in part B. Let us go forward and see what do we have in our part C. Emotional investing. So first of all, what is emotional investing? Emotional investing can be hazardous. Emotional investing is often an exercise in bad market timing. It mainly depends on the technical indicators or analysis. As a result, when greed creeps in, one tends to have selective hearing. Now this happens because in the given situation, one tends to be biased about their decision. Going forward, bad market timings can do all the damage. The reality is that the investor's psyche can overpower rational thinking during these times of stress. Whether that stress is a result of euphoria or panic, nobody knows. Taking a rational and realistic approach to investing is very important at this point of time. Because what seems like a short time frame for capitalizing on euphoria or a fearful market development is very much essential. Going forward, if we have to see the strategies that can be adopted to handle such situations, we have two most popular approaches to investing. One is adopting rupee cost averaging and the second is adopting diversification. Both have their unique features. Well, everybody is very well versed with diversification and its importance. So let us go further and talk about rupee cost averaging. Here in this graphical representation of rupee cost averaging, you will get an idea why is this so important. Now the bar here indicates the number of units allocated in every month starting from Jan 2018 till 2018 December. The SIP amount here is of 5,000 rupees. The line graph above indicates the NAV at which the units are being allocated. You can definitely see the fluctuations in NAV. Now, if I have to ask you, what is the average NAV of the scheme? Well, the green line that has come now indicates the average NAV, which is approximately rupees 10. The advantage of rupee cost averaging is that you get an average NAV in spite of fluctuation or volatility. We cannot predict or time the market, hence the most sensible decision is to keep investing regularly in a disciplined manner. It is important to convey the investor that patience is the key. The survival stages here clearly gives an indication of what I am talking. Though we have seen a similar kind of a graph earlier, but here there is an extension to it. As the investor enters in the market, he is very optimistic about the situation, he is excitement, but with the growing market, his excitement is now converted into greed. He invests more money, and what happens as soon as the market starts falling? The same excitement has now turned into fear, anxiety, and resulting into the panic situation. But here starts the stage 2. Here, if the investor shows patience and stays invested, stays in the market for a longer of time, the same panic can now be converted into a relief. And with a long term horizon, he can definitely achieve the goals that he has planned for. And you can see by the end of stage 3, the investor is definitely in the position of success. So that is what we all have been trying to communicate to our investor. But this is something that we need to dwell in again and again. This takes us to an important point, that what are the key takeaways. Investing based on emotions, it could be greed or fear, is the main reason why so many people are buying at market tops and selling at the market bottoms. Under, under, Underestimating risk associated with investments is one reason why investors sometimes make sub-optional decisions based on emotion. During periods of market volatility and rising interest rates, investors often move funds from riskier stocks to low-risk interest rate securities. Rupee cost averaging and diversification are the two approaches that investor can implement to make consistent decisions that are not driven by emotions. Staying the course through short-term volatility is often the key to longer-term success as an investor. Well, while dealing with our investors, the point that we need to keep in mind is that we all know from a personal experience that losing money can cause emotional wear and tear. Definitely, the level of wear and tear is different for each and every investor. So what we can do is stay strong with the investors and ask him to focus on the long-term investments. Let us go ahead and see the next principle. The next principle says is make a plan and stick to it. So it is very important to stick to your plan. Creating and adhering to a thoughtfully constructed investment plan is another way to avoid making short-sighted investment decisions, particularly when the markets are low. The plan should take into account a number of factors, including the risk tolerance and the short-term and the long-term goals. Few points that we need to consider and clearly communicate to our investors are: start small but start early. Ask your investor to start small but start early. When you let your investments grow for a longer period of time and you nurture them correctly, compounding works greater in your favor. This is what we have already seen in part B of our module. It is importantly to trade cautiously and do not take unnecessary risk. Mutual fund advisors are asking their clients to avoid unnecessary risk. Our investor needs to reassess their risk appetite and ensure that they do not take any steps that might expose them to unwanted risk. Investor should not alter their plan based on the temporary market conditions. One needs to ask the investor to have a proper investment plan and asset allocation plan in place. More importantly, It is said that do not alter your plan basis on the prevailing market conditions, because in such a situation they might lose a valuable opportunity to make money. Another important point that needs to be communicated is that the investor needs to learn to ignore multiple voices. Investors should remind themselves that they are in the market to achieve their long-term financial goals and learn to ignore the noise. Importantly, you should be the one point of contact for your investor. You should be the one point of contact for any queries that is coming from your investor, so that he can avoid the noise that is being created in the market. Also, willingness to invest when the market is low. Investors should consider their willingness to keep investing when share prices are declining. But here is the result of staying invested. In spite of fluctuations, disciplined investment reward you with higher number of units. Now, how is this possible? As you see, there is a fluctuation in the NAV. There are times when the when the NAV goes higher, you get less units. But at the same time, when there is a fall in the market, comparatively you get a higher number of units, which is very much beneficial in the long run. Results of staying invested. Now, when the stock prices fall, you get more units for the same amount of money and lower your average cost per share, as to what we have seen in our last slide. What is the investor's behavioral pattern? Let us see. It is natural for emotions to bubble up during periods of volatility. Those investors who cannot tune out the news and focus on their long-term goals are better positioned to plot out a wise investment strategies. So, in order to handle your investor, it is important that you need to understand his behavioral pattern. Definitely, I understand that you cannot control his reactions during the volatility, but at least you as an advisor can prepare yourself to handle his reactions. Well, with this, we come to an end of our part C of our module Handling Investor Emotions. In our next video, we will be talking about few important biases that can help you understand your investor better. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.